In this activity, I'm going to explain how the journal entries are driving what goes onto the cash flow statement. So there are several ways to attack a cash flow statement, but this particular activity is going to review all the journal entries that we've learned so far and show how it affects the cash flow statement. It's a great exercise to think about and use this time to review what's happening at these companies. So let's look at the first one. Starbucks Coffee issued 3,000 shares of $2 par stock for $5 per share. Let me take this dollar sign off there. So we are issuing stock because we want to raise money and we want to get cash. Okay, so we are going to debit cash, and we are getting 3,000 shares and the amount per share is $5. So we are going to say 3,000 times 5. All right. Now, the amount we're going to put to common stock, let me try that again, is always going to be the par value, which we can see is the $2. Okay. The rest has to go into paid-in capital in excess of par. So this is the difference between the $5 and the $2. So it would be 3,000 times $3. We could have just said what number do we need here to make it balance for this entry, and we still would have gotten the same thing. Okay, let's talk about why we credited what we did. Cash needed to go up because our company got cash. We make an asset go up with the debit. All the capital accounts have a normal credit balance, so they went up with credits. So what does this do for a cash flow statement? If we have memorized what goes on a cash flow statement, we are talking about the stockholder equity transactions. Let's see if I can get that, which is stockholders equity is down here in the financing section. Okay, so it's very simple to figure out with investing and financing what to do. If it makes cash go up, it's an increase, and if it makes cash go down, it's a decrease. So here cash went up. So we are talking about a financing activity, and this is an increase. Starbucks Coffee purchased 500 shares of its own stock for $1 per share. Owned stock tells us we're talking about treasury stock. When we purchase it, that means we pay out cash. So we're going to debit treasury stock, and we're going to credit cash. Okay. So treasury stock is a capital type transaction, but treasury stock reduces capital. So rather than having a credit balance, it has a debit balance. So we're getting it 500 times 1 would be 500. So we're paying out cash of 500. In this case, we're talking about a stockholders equity section. So we are still down here in the financing, but this time from our journal entry, we can see that cash went down. So this time in our financing activity, we are talking about a decrease for the cash flow statement. Starbucks Coffee sold 250 shares of treasury stock for $2 per share. It originally paid $1 for the share. So in this situation, we're still talking about treasury stock. Instead of buying it now, we're reselling it. So when we resell something, you get cash for it. And you give up the treasury stock that you had previously bought. So we're going to reduce our treasury stock. And any amount over the original price, we're going to debit to paid in capital, treasury stock. Remember, with treasury stock, par value never matters. All you're doing is comparing what you paid for that treasury stock to what you're reselling it for. So we got we sold 250 shares times 2, so we got $500, okay? But remember, the amount to reduce our treasury stock amount by is the amount we originally paid for it, and we originally paid $1 for it. Okay, so the difference between what we originally paid and what we're selling it for goes into this paid in capital. So we are getting $1 more for it when we sell it. So it's basically just a plug number. So we're still talking about stockholders' equity section of the balance sheet. And we're still talking about the fact that this belongs under financing. And this time cash went up, so it is an increase. Starbucks Coffee issued $500,000 bonds for $400,000. So we issue bonds for the same reason we issue stock. We want money. The difference in bonds is that we have to repay it plus interest. We got cash, so we're going to debit cash for $400,000. Okay, and we have bonds payable that we're going to have to pay back. I'm going to skip a line and I'll explain why in just a minute. So we're going to have to pay back the $500,000. So sometimes the plug will be a debit and sometimes it will be a credit. That's why I skip, so I can go back and decide which one it will be. And so it is going to be a debit. Okay, whenever you issue bonds for less than what you have to repay them for, we're going to put it in an account called discount on bonds payable. Okay, and so if we look at our sheet, not only does stock, issuance of stock and selling it, go in the financing section, also long-term liabilities such as bonds belong under the financing. So we are still talking about a financing activity, and we're getting cash, so cash went up, so this would be an increase. Starbucks Coffee redeemed the above bonds early for $300,000 when the unamortized discount was $25,000. So we redeem bonds. That means we paid them off early, and the unamortized discount at that point was $25,000. So we need to get rid of what we owed them. And we owe them the face value, which was $500,000. So we need to get rid of that balance. We had an unamortized discount of $25,000. So we need to get rid of that discount, and discounts have a normal debit balance. So to get rid of the discount, the remaining balance that's left, we would credit discount on bond payable for $25,000. Okay, and it tells us that we had to redeem the bonds early for $300,000 cash. Okay, so we're not in balance at this point, and the reason is because we either have a gain or a loss. So you may want to skip a line in between your credits and debits in case you have a loss. But in this situation, it looks like we have a credit balance left because the credits are smaller right now. So we're going to have a gain, and to get the gain, we're going to take the debit balance and subtract out the credit balances. And let me do, that's D59. Okay, so $175,000 gain. That is a gain on the early redemption of bonds. Now, you could have calculated that by taking the carrying value and compared it to the amount you had to pay. And that would have also told you that there was a gain on early redemption of a bond. But how do we report this? Well, first we need to remove the gain that showed up in our income. Because remember, this gains do not involve cash. So we're going to remove the gain. So remember, removing gains goes in the operating activities. And so the gain was a plus. So to remove it, we would need to subtract it. So it's a decrease. And the second portion of this is what we were talking about, a long-term liability, which tells us that it's financing. Okay. And what did cash do with that long-term liability? It decreased. So the operating account decrease would have been for the gain of the $175,000, and then the financing section, the decrease would have been for the $300,000. Okay, given the following partial balance sheet and partial income statement, journalize the cash dividend paid for the current period. So what we have here is the fact that our retained earnings went from $600,000 to $620,000, and we know that net income should have increased it, and it did by $30,000. So if I look at what happens to retained earnings, this is what we're going to do, and this is what we're going to find. Let me move this over. I'll have it over here. So we have retained earnings of $600,000. We add net income. Okay, we did not know dividends. Okay, so how do we find dividends? Well, we take our retained earnings and our net income. That's $630,000. And retained earnings ending balance is $620,000. So that must mean that we paid out dividends of $10,000. Okay. So that helps us with our dividend payout, but let's look at what the journal entry would look like. You would debit cash dividends for $10,000. This is when you declare it. And then you would debit dividends payable for $10,000. And I'm going to continue this in the next video. We'll continue this journal entry.